All right. Good afternoon, everyone. Thank you for joining me today. I'm Raiden from FSM Dealing Team. So today's topics will be inflation protection and global exposure via SGX REITs and ETF. So the word inflation, I think is one of the things that we concern the most throughout these few years. And maybe today I give you a 50 ringgit and go to the supermarket and buy some groceries. Can you still get the same amount of grocery as compared to 10 years ago? The answer is no, right? And just now, before I come up to the stage, I have a quick check on the inflation rate for the past 10 years. And it's saying that the average inflation rate for the past 10 years is 2%. Do you think it's really 2%? I think yesterday I went to the kopitiam and have a kopi peng. Remember 5 years ago when I drank it, probably it's already 3 ringgit. But now it's around 4 or 4.50. Do you think this is only 2% increase? No, right? So now the question is, how can we as a normal citizen or a retail investor protect ourselves against this inflation? Do you think working hard, earning more money, putting it into the bank, save it, can help us? No, right? And what if now I tell you there's one instrument that can help you hedge against the inflation and protect our capital against the inflation? And this is our topic today. So before diving into it, we need to pause here for a while so that everyone is aware of the disclaimer. All right, REITs, also known as Real Estate Investment Trusts. Basically, they own and manage properties such as shopping malls like Pavilion Bukit Jalil, hotel, office, and many more. So for REITs, they are highly liquid. You can trade it over the exchange whenever the market is open. And they give you a consistent dividend. And also, you can gain real estate exposure without owning physical property. So now today, if you are interested in Pavilion REITs, you can just buy it over the exchange, and then you can tell everyone, oh, I'm one of the owner of Pavilion REITs. And maybe your wife can tell you, hey, let's go to Pavilion. I need to do some site checking today. Not shopping, I just want to monitor the business. All right, but our focus today is on Singapore REITs. So you will ask me, why Singapore REITs? I can answer you in 4 words. Small market, big opportunities. This morning, I had a conversation with 2 young married couple. I think they are there. Yeah, so they invest a lot in SGX REITs. And then I asked them, what made you so confident to SGX REITs? And their answer is exactly what mentioned above. So I will start from the right side. Strong regulatory framework, strong government and economic stability. They tell me, Singapore economy is stable, and their regulatory framework is very stable. Their policy is very firm. That's why this really boosts the confidence of the investor to invest in the stock market. And then they tell me, Asia gateways for global capital. So for a lot of multinational companies, when they choose a place to set up the headquarters in Asia, I think one of the places they will choose will be Singapore. So when all these multinational companies come in, what will happen? The demand for office definitely will be going up. So when the demand go up, what happened? It will link to the point number 1, high property value. So what high property value, what will it benefit us? Definitely the rental fee also increase. So rental fee. So this is a very important point here that I want you to remember, which I will explain in the next slide. And one more thing will be diversify global exposure. So in Singapore, other than investing their properties in Singapore, the REITs also, they also will increase some investment in properties in other countries like Australia, South Korea, Japan, and many more. All right, so now let's learn the money flow behind REITs. The one important term when you invest in REIT that you need to know is net property income, which is the money that distribute to investor after deducting all their fees and expenses. So for REITs, they are required to distribute at least 90% of their taxable income to the investor as dividend. Then you will ask me, how the REITs generate their income? It's definitely, they have a lot of ways that can generate income. But always remember, their main sources is from what I said just now, rental income. By collecting the rent, they generate their income, and then they will give the income as a dividend to the investor after deducting all their costs. Now, after understanding how they generate income, you will ask me, high rental fee, how can it hedge against inflation? And that's where I want to tell you the beauty of REITs. So I will use the retail REITs as an example. So usually retail REITs like Pavilion Mall or maybe other mall like Mid-Valley, they will have a base rental rate and also variable rental rate. So base rental rate is basically like the normal agreed fees that we will pay every month. Like let's say 5,000. Then every month you need to pay a 5,000 rental fee. Then for variable rent, it's based on tenants' percentage of their sales. So if let's say today, the sales of this shop is very high, so the REITs, they can take part of the percentage from these sales. So usually, let me ask you, when will the sales of this retail shop going up? When people spending more, and also when the product price going up. So when product price going up, it means what? Inflation, right? And also, there's an escalation clause. It can be either fixed or inflation-linked annual rent increase. So they will have an agreement saying that every year there will be an increase of rental fee. It can be fixed or it can be based on the inflation rate. So let me take an example from the Singapore REITs, which is the CapitaLand Integrated Commercial Trust. In the short, it's called CICT. So for this CICT, they own some landmarks mall like Iron Orchard, Bugis Junction, Plaza Singapura, and Raffles City, Singapore. So if you never been there before, they are just like a Mid-Valley Pavilion, Pyramid kind of mall in Singapore. And you can imagine the crowd there. So one of the things that I'd like to share also, when you invest in REITs, right, one of the things you can look at is the occupancy rate. The higher the occupancy rate, meaning there are more people renting the properties. So of course, when we own a property, we hope that there's people renting our property so that we can collect rental, right? All right, so looking at here, the line in blue is the inflation rate, and you can see for this red color line will be the dividend per share. What I want to focus on here will be the dividend yield. You can see from 2019 to 2023, the dividend yield will be above 5%. But you will ask me, 2024, how come the dividend yield becomes so low? Because by right, they're already giving a very consistent dividend. But what happened on 2024? So we have to know dividend yield is affected by two items, dividend and share price. Since the dividend is so consistent, what happened will be the share price is increasing. So what makes the share price increase is when people rushing in to buy in these REITs. So why people is rushing in? Because during the 2024, there's a lot of uncertainty on the inflation. So people are trying to rush in so that they can have the instrument to hedge themselves to hedge against the inflation. All right, after talking about the beauty of REITs, let's talk about something stable, the stability of REITs. So I will take a commercial REITs as an example. So they don't have something like a variable rental fees like the retail REITs, but they only have a base rental and a fixed annual rent increase. Then you will ask me, how can this be stable? Since if let's say anything happen, they always just have a base rental fee. So the answer is from the tenant. Example for Keppel REIT, they focus on Grade A office building, such as Marina Bay Financial Centre, One Raffles Quay, and Ocean Financial Centre. So usually in Singapore, as we mentioned just now, their tenants for all these office usually is multinational companies like Google, JP Morgan, Alibaba. So when you rent all these office to this kind of tenants, will you worry about that they can't pay you the rental fees on time since they are so financially stable? As compared to SME and also the, what we call that, the small business, definitely they can afford the rental fee. And as we can see from a dividend chart here, they're giving a very stable dividend. And looking at the dividend yield, you can at least get about 6% every year. And now you will tell me, after listening the beauty and the stability of the REITs, then you will tell me, Raiden, now I have a very small capital, but I would like to enjoy both beauty and the stability of it. What can I do? Here's one more tip for you, REITs ETF. So what is a REITs ETF? It's basically a combination of REITs and ETF, which provide the real estate exposure with the structural benefits of ETF. So for REITs ETF, you can gain diversified exposure to real estate across different regions, lower entry costs, and you can easily adopt to the regular saving. Of course, just like the normal REITs, it gives you a consistent dividend and highly liquid, which you can just trade it whenever the market is open. Now, looking at this example, Nikko AM Straight Trading Asia X Japan ETF. So we look at the fund holding, which is ETF holding. Imagine today, if you want to buy in all 10 of these top 10 holding of the REITs here, how much money do you need? If I assume $100 for each of it, then you need 1,000. But now I can tell you, with $100, you can already buy into this REIT ETF and start getting exposure to all these REITs here. And also, looking at to the sector allocation and country allocation, you can see that this REIT ETF has an exposure to all kind of sector in REITs, right? REITs, office REITs, and hotel and resort, and many more. And also, their country allocation is in Singapore, Hong Kong, India, and many more Asia countries. This achieves what we want as a diversification. So, looking into the dividend, we can see that the ETF REITs, there is still giving you a very consistent dividend payout, just like a normal individual REITs. And then the dividend yield is giving you above 5%. So this is something that we should consider. And this comes to an end to my sharing today. So let me ask you back the questions. Do you think working hard and saving more money can help you to hedge against the inflation? So what if now, if the answer is no, what if I tell you, now there's a product, there's an instrument that can help you to hedge against the inflation? Will you give it a try? And this product is what I mentioned just now, REITs or REITs ETF. Yeah, so I hope that after these sessions, it gives you some new investment idea in your investment strategy. And once again, thank you for joining me today. Happy investing, everyone.